because now we're going to go to the second talk, I think. And first talk we had was introduction to volatility and skew, and Rocco gave some very, very practical approaches to that. And now in the second talk, Rocco is going to go on and look at some more advanced, somewhat more advanced concepts, including some proposals he has for looking at things a little bit of a different way. But I'd encourage people to stick around who are here, because I think you'll still get a lot out of it, even no matter what level you're at. So I will give it back to Rocco.
Right, thank you, Don. So yes, this second piece, this second part of the presentation, it's more of a research component. There obviously there's some practical application, and I'll show you those as well. But there is a bit of a math involved, because when we're talking about Greeks, so unfortunately there's a little bit of math on this side. So I already talked about this slide earlier, so I'll just bring it up again, because I want you guys to focus on the shape of the normal distributivity function, the normal distribution, the normal probability density function, which is denoted by n. And so what we are actually interested in is the concept of Vega. So Vega, as you all know, is a Greek that measures the sensitivity of an option price to a change in volatility. So what happens when the volatility increases? How much is my option going to make or lose? And so essentially, being a first level derivative, this is the derivative of the price with respect to implied volatility. And this is essentially the formula, where S is the spot price, N is the normal density function, and there's a D1 is all the parameters. There's a kind of a longer formula that I showed in the previous slides. And tau is square root of tau is the time effect, tau is the time to maturity in years. So long options have positive Vega, short options have negative Vega. And what we're seeing here is two graphs where on the left side, we're looking at how the Vega looks like as we change the spot price. So depending on, so obviously this is the at the money on the center. So the Vega is the highest at the money. And as we go away on the left side or on the right side to where the strike price is, basically this shape is very similar to a normal distribution, but it's not exactly normal distribution, because it is multiplied by S, which is the stock price. So it on the right side is a little bit higher. Now on the right side is actually the how Vega changes based on how far in time you're buying or selling these options. So essentially, this chart shows you that obviously much like longer dated options tend to have higher volatility, they also tend to have high Vega. Now, this is something that we'll talk in a moment. You'll see that it's not always that true in practice. But at least from a theoretical perspective, this chart is telling us essentially that the Vega increases the farther in time we go. So going to the next step is, obviously, I'm not always just buying a single option or selling a single option. I'm buying and selling a combination of them. So if I'm buying a spread or selling a spread or a butterfly or a calendar or whatever, what I do is essentially in this case, let's say we have a butterfly, which is a 40, 30, and 20 deltas. We take the Vega of each individual option, we multiply by the quantity and do the sum, and that's the total Vega. So this simple calculation in this example is telling us that this butterfly has a negative Vega, which means that it loses $31 if the implied volatility increases by 1%. Obviously, it gains $31 if the implied volatility decreases by 1%. Obviously, everything else being equal. So if the spot price doesn't change, if the time doesn't move, I mean, basically, if instantaneously there was an increase in 1% in volatility, what would happen to the price of my broken butterfly? Now, here's the problem. I just said if the implied volatility changes by 1%, but I didn't say which volatility is going to change by 1%, because we have 3 strikes. And so in reality, what that statement actually means that if the volatility of each option in my position changes by 1%, goes up or goes down by 1%, but we're saying that every single one of those options has the exact same increase or decrease by 1%. This is what Vega is actually measuring today. And here's actually the problem, because this is not really a realistic interpretation. And I'll explain why. We've just talked about the concept of skew, and we've seen how there can be put skew or there can be call skew. And so if I have a butterfly, which obviously is 3 different strikes, 3 different options at 3 different strikes, it is really not realistic to think that the volatility, if it's going to go up, is going to go up by the same amount on each strike, on each leg. And so, because that essentially what Vega is measuring is a shift of the entire curve, of the entire volatility curve, a shift up or shift down by 1%. But in reality, we know that we have different strikes, each one has its own volatility, and so they may not all increase or decrease by the same exact amount. And so calculating the entire, looking at the entire Vega of a position in presence of skew, it's not always a good measure. I mean, it gives us an idea, but you shouldn't trust blindly those numbers, because again, in reality, the volatility does increase by the same amount across every single strike. But there's another problem where we also talked about the volatility term structure, and we've seen that essentially volatility changes across time, and also the Vega, as I showed you earlier, changes the farther out in time we go. So how do we deal with calendarized strategies? If I'm trying to calculate the Vega for my calendar, where I have 2 different expirations, now and my Vega, let's say, is 1,000. That would mean that if the volatility goes up by 1%, I'm going to make $1,000. So this is typical. So one would typically say, well, calendars are Vega positive strategies, and so I expect to make a lot of money if the volatility goes up. And in reality, that's not always the case. And that's because, again, the volatility doesn't increase by the same amount across multiple strikes. There could be condition where a temporary backwardation, for example, especially if I bought a short-term calendar and a news come out, maybe my short strike, my short option, is going to suffer more, because the short-term news tend to affect more shorter-term options than the longer-term options. So even though on paper my calendar is Vega positive, it's not actually always going that way in practice. So how do we try to mitigate this effect? Here there's a concept of weighted Vega, which is essentially, this is described by Nassim Taleb in his book called Dynamic Hedging. But the concept of this is, and actually I would encourage you guys to search on YouTube for the concept of weighted Vega. I believe there's a very good explanation, and there's a whole, I think, 1 hour and a half of video done by Rombertino explaining various aspects of these and various myths about these types of strategies that rely on Vega. And so I really encourage you to look at this one for a better explanation and kind of more longer term, more kind of detailed information. But I'll try to give you an idea here, which is if you drop a stone in the water, it creates ripples, and obviously the ripples are bigger closer to where I dropped the stone, but the farther out in time, as the circles of those ripples go away, the ripples are getting smaller and smaller. And so you can think of the fact that the Vega farther dated option, even though they have on paper a higher Vega, in reality, you can think of the fact that volatility, they are less affected by change in volatility than shorter dated option, because shorter dated option is like they're closer to the news, they're closer to the events, and so a spike in volatility tends to have more effect on the closer dated options than on longer dated options. And same way as if you drop a stone in the water, the closer you are to the water, the more you see the waves, and the farther away you are from the point of impact, the less you feel that impact. And so another piece of this puzzle that I'm going to add is the fact that obviously if we look at the VIX index, which is an index that measures the volatility, it's calculated, it measures basically on an average of 30-day volatility. It measures what would be the volatility, the implied volatility over the next 30 days. And so there is this formula, actually, Nassim Taleb in his book talks about multiple ways you can calculate, you can adjust for this effect. The one that I'm presenting here is the simpler one, and essentially what it does is it weights each vega of each option based on whether these are farther dated option or longer dated option. So the farther out in time an option is, the less the vega is going to be, according to this formula. And the closer you are to 30 days in this case, the more the effect of the vega, the true vega of the vega that you calculated normally, it would be. And so actually the number proposed by Taleb is 90 days. But I think using 30 days and also Ron explaining these videos, but I think the 30 days is actually a better option because everyone, when we talk about an increase in volatility, we are typically looking at an increase in VIX. And so if you're thinking about the volatility increasing by 1%, we're probably thinking about the VIX is going to go up by 1%. And the VIX is measuring a 30-day volatility. So it's good to have a 30 days as a point of reference for doing this calculation. Essentially, what this does is weighting, assuming that the volatility goes out with the square root of time, which is a purely theoretical model. There is another method proposed by Taleb, which is based on the concept of the future of the forward volatility. It's more complicated because it actually requires you to have data about the term structure of multiple points on the term structure to be able to calculate what the weighting would be. But for all intents and purposes, this formula is actually pretty good, so we can actually use it. So what I did in these two charts is showing you the blue line is the nominal vega, and obviously this is we're looking at an option which is more than 30 days away, and the red line here on the left is what the equivalent weighted vega looks like. As you can see, the weighted vega is much smaller compared to the nominal vega if you're looking at longer dated options. But here's the interesting piece, right? I showed you earlier how the blue line shows you that the vega increases as the days to expirations increase as well, right? But in reality, if you apply the weighted vega formula, essentially we end up having this red line, which is essentially a flat vega. What this does is the weighted vega is nothing else than equalizing the volatility, such that if you're only looking at as if you were always buying 30 days options, essentially saying this 180-day option, in reality, the vega is like if I bought an equivalent option, which is only 30 days away from now. And so it's calculating what the vega of that fake option, that theoretical option would be. And as you can see, it's basically flat across the DTE. So by using this mechanism, you can actually calculate the vega of multiple legs, especially for calendar structures, right? Because that's where you really have multiple expirations. And you can now sum the individual vegas, the individual weighted vegas all together, because now you're comparing apples with apples. You're not comparing apples with pears or something else, because they now are all being equalized using this formula. All right, so we solved one problem, which is the problem of the term structure of the volatility, but there's still one piece of the puzzle, which is what about the skew? I said earlier that the volatility doesn't stay constant across all strikes. It changes all the time based on the skew. So we cannot simply add the vegas or of all of these options as they are, because when the volatility increases, it is not going to increase the same way across every single strike. So unfortunately, there is no solution for this, or at least until today. And what I'm going to show you is something that it tries to address this problem. Now you'll tell me and if this is good enough for you, but I feel it's a good approximation to get a sense of what actually is happening to my position as a result of the skew. So to get there, we need to model a little bit more. So we need to understand again. Let's review the skew and let's try to understand what happens. So let's say we have the at the money strike, right? And that's going to be the volatility of the at the money. And then we take another option, in this case, for example, a put with a certain strike out of the money. So the green dot obviously represents the implied volatility of that option. Now we can actually kind of decompose the entire volatility of the option that I'm buying, of this particular strike, as if it was made of two pieces. A piece which is the volatility at the money, and then a second piece which I'm going to call the skew volatility. This basically is an additional increased volatility which is due to the fact that there is skew in my option, and so the total volatility is obviously the sum of these two terms. Okay, cool. So in theory, it's like if we had a rotation. It's like if we basically had a rotation of an angle which I called theta. This is not to be confused with the Greek theta, which measures time. This is just a measure of an angle, and it's like if we actually rotated from this point all the way up to that point. And as you can see here, it's a simple triangle here where we know what the distance is between the at the money and the strike. So we know one side. We know what the height of this rectangle of this right triangle is, and so we can actually calculate what the angle is because we know what the total volatility of the option is. We know what is the volatility at the money, so obviously we can calculate what the sigma skew is, and now we want to calculate what the angle, what the rotation is. So essentially, we're trying to measure how much of a rotation happens, how much is the skew, and we measure the skew as a form of rotation across a pivot point. And the pivot point is the at the money. So obviously, simple trigonometry, and we find out that the theta is the arctangent of the ratio between the two sides of the triangle. And obviously, we can invert the formula to calculate sigma skew based on the distance from the money and the angle theta. Okay. All right. So now we get this piece. So if we go and look at the total volatility, I just said that this is the sum of two parts. Is the sum of the at the money volatility plus this piece, which is essentially dependent of an angle, right? It's basically a rotation. And so, and here we have the formula, right? So when I'm looking at calculating the Vega, now actually I want to decompose my Vega into two parts. I want to calculate what is the effect, what is the Vega that is due to the at the money volatility, and what is the Vega that is due to the skew. What does it mean? Well, if we look at the Vega of at the money, and we actually do the formula, it's very straightforward to show that essentially this is nothing else than the Vega that we already know today. This is literally the Vega that we've been talking for until now, because essentially what this is implying is that if there is an increase, what this derivative is telling us is measuring how much of a change there will be in the price of an option if the at the money volatility went to go up by 1%. And so essentially, it's like if you're shifting an entire curve up or down, well, if we were to do that, then obviously every single strike, every single option would also have the same 1% increase up or down. And that's exactly the definition of the Vega as we know it today. So there's nothing new there. We didn't discover anything new here. But now let's go and look at doing the same calculation for the second Greek. So by doing a partial derivative with respect to the angle theta, essentially the formula is this left part, the white portion here, is exactly the Vega as we know it, and then the right side here is basically the the new piece that multiplies it, and then and it takes into account the rotation. So what is this formula giving us essentially? What are we trying to measure here? Well, with the Vega, the normal Vega, we were measuring what would happen if the volatility goes up or down across every single strike in the same way. So the entire volatility curve shifts up or shifts down by 1%. With this measure, we are essentially trying to find out how much will the price of the option will change if there is a rotation, if the skew moves by 1% of a degree. And that's why you have this pi over 18,000, because it's basically, it's a conversion from radians to degrees, and then there's an extra 100, which is basically to measure a 1% of a degree. So what does it really mean, 1% of a degree? Well, and actually, what does it really mean, this whole thing? Well, going back to this chart, we talked about, let's say I bought this option, right? And this was my original volatility. I know what the Vega-Skew is. I know what the angle is because I can calculate. I have all of this information. I'm trying to understand what would happen if actually the skew were to increase, right? Then the volatility would go from this point to the new point. Well, this is like if I had an increase in the angle, and I went from the angle theta to the angle theta prime. And so I'm trying to measure how much of an increase there would be in this volatility if the angle were to increase by exactly 1% of a degree. Now, what is 1% of a degree? Well, if you look at sorry, I'm missing the word for this. It's called proctangle. I can't remember how this thing is called in English. It's called chronometer in Italian. Anyway, we are looking at one little. We go from 0 to 1, and we're taking 100 of the space between the first tick. So it's a super tiny increase in the rotation. Well, you will see in a moment that even a super tiny increase in the rotation, it can make a difference. It can make your volatility to go up by quite a lot. And so I also prepared a file that I will show you in a second. But before we get to that point, I want to kind of analyze a little bit more about what are the properties of this Greek. And so first of all is the fact that to calculate the Vega-Skew, we need to use this concept of a dynamic at the money strike as the pivot point. What do I mean by that? Well, if we go back to this diagram, well, to measure an angle, we need to have a pivot point, right? So the choice of which pivot point we're going to use is arbitrary, and I chose the at the money strike. So I'm measuring how much of an angle there is from the at the money strike. So obviously, as the at the money moves around, I need to keep following where the at the money is and keep remeasuring, right? So the Vega obviously is sensitive to where is the at the money, and I need to know what is the volatility of the at the money. Then the second piece, and this is actually very interesting part in my mind, is that the farther you are from the at the money, the higher is the effect, the larger is the effect of the rotation. Because when we look at the classic Vega, essentially we're saying every strike goes up or goes down by the same amount. But when we're looking at this rotational Vega, well, if my option, let's say, is here, obviously there is if there's an increase of 1%, let's say, of the angle, well, my volatility goes from the green dot to the red dot. But if I were farther out of the money, the corresponding increase from this point to the next point would be much higher, because obviously when there's an angle, the farther you are from the point of origin, from the angle, the more the distance there is, the higher the volatility will be. Essentially, what this is telling us is that farther out of the money options will have a higher rotational Vega, which is actually consistent with what we see in reality. When there is an increase, when there is an increase in skew, well, we see that the teenies, the 2 delta or 5 delta put, they increase a lot and that's also because of the fact of Voma, which is a second order Greek, but it's also because of the fact that the skew is changing, and this skew essentially is measured by the rotation, right? So the farther away you are from the pivot point, the more you feel the effect of the rotation. Another property is that obviously this Vega-Skew is zero at the money. Why? Well, because the at the money is the pivot point, so the angle is zero. I mean, essentially, there is no rotation. If your strike is already at the money, well, there is no rotation, there is no skew, because you are literally in the middle, the point from which you're measuring the angle. So this is going to be zero by definition. And this other point is that in reality, you always have to consider that there are two parts, right? We talked about how the total volatility is the sum of, let's say, an at the money volatility, which is a shift up or down, and then the rotation, which tells us how much of a skew there is. And so in reality, we have to look at both Vegas, and the effect is never one or the other. There's never a case where the volatility only goes up because of a shift or because of a rotation. The two things happen together. And so it's always a mix of the two components that are really going to affect the total volatility of our option. And to equalize across time, the same way as we did the weighted Vega for the normal Vega, we can apply the same formula for calculating the weighted Vega of the Vega-Skew, essentially. Okay, so now, enough with formulas and in charts and everything else. Like, okay, how about looking at what does this really look in practice? So I have I'm going to share another document. Right. This. Okay, so this is an Excel file that I prepared for the students for the company they're working. I mean, not for the company, for the financial education company. We have a bunch of students, and obviously I prepared this document for them. So I will not be able to share this document with you guys, but I created a simplified version just to calculate the Vega-Skew that I will be able to share. But I wanted to use this document because it helps kind of understand a little bit more what the effect is. So what I have here is a broken wing butterfly. So I have in this case was a 50, 30, and 10 delta put. So one bot, sold two, bought one at certain particular strike. So this is the graph, and on the bottom here we have all the Greeks, theta, delta, gamma, Vega. There's also this weighted Vega, so I can actually switch between normal Vega or weighted Vega, so I can to get a feel for the actual the real effect. And then on the bottom here we have this Vega-Skew, also weighted or unweighted. So let's take a look at how this Vega looks like if you just look at a single option. Okay, so I have a single put. This is an at the money put, and the at the money is right here. So as you can see, the rotation is going to be zero, because, well, if I'm at the money, well, there is no Vega in that. There's no rotational Vega in that point. There's no angle. Okay. Then I look at an option which is, let's say, 10 delta. So that's going to be farther out of the money. So I'm going to put one here. And essentially, remember, the at the money is where this this little blue line is. So if we kind of scroll down, it's somewhere around this point, around 3,800. And as you can see, this is showing me that there is a rotational Vega component. So this is the amount of rotational Vega. So if there were to be an increase of 1% of the degree in the rotation, how much of money would I make or lose because of this rotation? And obviously, the more the stock price, the underlying gets closer to the at the money, the less the effect of the rotation is going to be, because when the stock gets exactly to the strike, then obviously at that point there's no more rotation. It's only normal Vega, and there's no more rotation. And obviously, when I combine all of these things together, I can see, let's say, going back to the full butterfly, I can see that if you look at the typical, in this particular case, that this broken wing butterfly, this would be negative vega in the traditional sense, in the center, but actually as a positive rotational vega in the same area. So this actually is telling me that yes, if the volatility, if there is a shift of the curve up or down because the overall volatility of the market increases, then this position will suffer as a result of the nominal vega. However, if combined with the increase of the volatility, there's also a rotation, an increase in the rotation, then that rotation is going to help me because I will actually make some money because of the fact that there's a rotation. Because remember, you have one long, two short, and one long. So depending on how the rotation happens, I may make money based on the fact that the long ones, which is farther out away from the other money, is going to have a higher rotational effect, and that will compensate for the rotational effect of the two shorts that I have over here to a certain degree. And so, again, this is a way to kind of understand a little bit more. I mean, to see that it's not necessarily true that a butterfly is always a vega negative or the calendar is always a vega positive. You also have to look at are you at the money? Are you far away from at the money? What is the skew implication of all of this? And finally, you have on the right side here is showing me because while it's easy to imagine what it means a 1% increase in the volatility, it's not that intuitive to understand what does it really mean a 1% increase in the rotation of the annual. I mean, it's not something we can measure easily. So this bar here, this kind of chart here is showing me for each strike, essentially the orange bar is the current volatility, and the gray bar is telling me what the new volatility would be if there was a 1% rotation of the skew. So that means that this 10 delta strike would go from 25.74% to 28.88% implied volatility. So there's quite a big of a jump. And obviously we can expect that because this strike is farther out of the money. So it's the one that feels the rotation the most. The second strike here, these are the two shorts, so it refers to the strike in middle. And where's my chart again? And so here, for example, following a 1% rotation, the volatility would go from 22.9% to what value? To 24.21. And the third one essentially remains the same. Why? Because this strike is essentially at the money, and so there is no rotation. So that's why the volatility pretty much remains the same. So obviously, as I was saying, I cannot share this particular spreadsheet, but I created a Google sheet that I'll show you in a second. So this document, hopefully you can see it. What do I do here is basically, am I still sharing? Can you guys see my screen or not? Looks like I'm not sharing. Okay, hopefully you can see now. So in this spreadsheet, this is a very simple one. Essentially, I specify what the ticker is, and this is going to use the Google Finance to get the spot price of the particular index. So .inx is essentially the symbol for the SPX. Not sure why Google wants it this way, but that's how it's called in Google. You have a couple of parameters in here. You have the strike step. So obviously, if you're looking at SPX, the strike size, the difference between two consecutive strikes is $5. But obviously, if you're doing, for example, Apple or any other underlyings, the strike step might be just $1 between each strike. So you may want to adjust that depending on which underlying you're looking at. This is just to measure how many days are in a year. This is used to calculate the maturity in terms of years. And you can adjust this depending on whether you want to use 365 days or 220 business days. I mean, up to you. Here you specify your interest rate. And we'll talk about this too in a second. So what I'm going to do here essentially is I'm specifying an expiry date. Then the strike price that I'm of the option that I'm buying or selling. Obviously, the quantity, if it's positive +1 means that I'm buying. If it's -1 means that I'm selling. I need to specify what is the strike. Well, I don't actually have to specify it because this is automatically calculated. It finds out what is the closest, the nearest strike based on the last whatever the value of the underlying is. So this is automatically calculated. Here is I have to manually input what is the volatility of the strike of the money of this 50-70 strike, and what is the volatility of the strike of my option, which in this case will be the 50-55. Okay, now I don't have to specify whether it's a put or a call because when we calculated Vega is the same for put or calls. It doesn't matter. The formula is the same, so it doesn't really matter whether we're looking at puts or calls. Then I have to specify how many days. Well, actually, based on the expiry date and the today's date, this is going to tell us what the days to expiration is. And this column is basically showing what is the Vega, what is the Vega-Skew, what is the rotational Vega. This is a time factor that is used for calculating the weighted Vega. And so here we also have the weighted Vega and the weighted Vega-Skew using this time factor. And this is actually something that you might find useful if you are using Thinkorswim. So let me actually, well, I'll get back to Thinkorswim in a second, but when you look at a position on Thinkorswim, you have the ability to simulate what would happen if the volatility were to go up or down by a certain amount. But you can do it on a single parameter, and if you do that, it would basically change the volatility of every single strike, every single leg that you have by the same amount. Or you can actually go leg by leg and specify the individual volatility increase or decrease that you want. And so this number is taking into consideration what would be the weighted factor, meaning that if I wanted to simulate what the impact of 1% increase in VIX would be, I would go into TOS for this particular strike, and I would adjust the volatility of this particular strike by 0.57, not by 1%. Why is that? Because this is an option which is 91 days away, and so that means that the effect of the weighting of the weighted Vega is going to be lower, and so I only have to increase my to simulate the volatility increase. I would only have to increase by 57%. If I actually had an option that expired, let's say March 29, so it would be exactly 30 days from now, then essentially I'm already looking at a 30-day option. So the adjustment that I put is 1%. So I don't have to adjust anything else. So if I wanted to simulate a 2% increase in VIX, I would go and change 2% here. And this number would tell me how much would I have to increase the individual option. So imagine that I have, let's say that I have a spread. So I'm going to copy this formula. We're going to change the expiration to be, let's say, May, for both of them. And this is going to be a 50 20 strike. Why is this not showing us the? Well, this would be exactly 70. So I'm gonna fix the formula here, but essentially this would be the strike, the RTM strike. The volatility of RTM is still the same. Obviously, I would have to look at what would be the volatility of that particular strike. Let's say this is the 50-20. So maybe it's a little bit lower. If this is a put, let's say it's 15%. And obviously, maybe I'm buying this strike and I'm selling the other one, so I would put -1. So if now my expiry date is, yeah, as you can see here, is a 91%, right? This is telling me that if I were to increase by 2% my if the VIX were to increase by 2%, I would actually have to simulate this one by only adding 1.15% to both my options to simulate, to see what the effect would really be on my entire position. Obviously, if I had different expirations, these values would be different. So, and the same story here is showing this this final column is showing us what would happen to my volatility if there was a 1% rotation in the angle. So it means that our implied volatility would go from 15.37% all the way up to 16.34 for this particular option, and it will go up from 15% to 15.88 for this other option. So again, this is measuring you, it tries to give you an idea of what a rotation would do to your actual, to the implied volatility of the strikes that you have selected. So then once you have this information, you would just go to Thinkorswim. I'm gonna share again Thinkorswim. And if I'm analyzing a particular position, as you can see here, I can actually click on this chevron icon, and I can either increase the volatility here, but if I do this, this is going to increase the volatility across every single strike the same way. This is basically a parallel shift up or down of the volatility. While instead, what I would do is I would look at that value that was coming from the Excel and perhaps change this value by 0.4 and the other value maybe by only 0.2, depending on what the spreadsheet would tell me. So this way I can really model a little bit better what the impact would be of an increase of 1% in VIX. Finally, I want to show you another application of, so I will share the Google Sheet that I created with you guys. So Don, at the end of the presentation, I will send you the slides with the link and everything else. But there's one final thing that I wanted to show you guys, which is how do we use this concept of rotation to help us out in some of the trading. Now, again, this is another file that I cannot share, but at least I can, something that you can at least hopefully it's going to help you understand a little bit more what's going on. So what I did was I looked at a broken wing butterfly with a specific expiration and with specific strikes, with specific deltas. So this was a 40 deltas, 40, 30, and 20. And essentially, by looking at what was the volatility of, at the time of entry, of those three strikes, the volatility at delta 30, volatility at delta 40, volatility at delta 20, and I measured what was the rotation with respect to the at the money. Again, the at the money volatility with at the time of entry, at the time of entering that particular trade. And essentially in this chart, I can see well, let's start with the one at the bottom. This is every single one of these dots is showing me what the rotation, rotation that was calculated was for the 40 delta strike, the strike that was at delta 40, when the corresponding volatility of at the money was a certain value. So this is telling me, for example, that for this particular dot, when the at the money implied volatility was 40%, the rotation, the rotation of the angle for the 40 delta strike was 0.1197, right? So every single dot represents a pair of at the money volatility and the rotation of the angle. And obviously, and here basically is the linear regression that shows you how these dots are distributed. And there is some level of correlation. It's not super high because predicting the rotation just by looking at the money strike, it's not that easy. I mean, it's not going to be very predictive. However, if you look at these other two, where each of these dots is telling me if I know what the rotation is of the delta 4 of the 40 delta strike, can I say anything about the rotation of the delta 30? essentially I have a BWB. I look at the strike at delta 40, and I measure what the rotation is of that particular implied volatility. And if I know that value, can I say anything about what the implied volatility should be of the strike at delta 30? And so, as you can see here, actually, all of these dots are in a straight line, which means that I can actually do fairly accurate prediction of what the theoretical rotation should be for the delta 30 and for the delta 20. So great, but how do I use all of these things? Well, I can actually come up with a simple traffic light that where essentially if I want to trade this particular trade, I can put what is the volatility at the money. I have to put the volatility of the strike at delta 40, delta 30, delta 20, and a bunch of calculations will happen. And basically, this is measuring the actual skew. This is measuring what our prediction would be. And essentially, these traffic lights is telling us that if it's green, it means that this is a good condition. It means that the skew is such in a way that I am actually buying, because the 40 delta, this is 40, 30, 20, this is the 40 delta. This is a strike that I'm going to buy. This is the strike that I'm going to sell. And this is the strike that I'm going to buy. So obviously, if this is green, it means that I'm buying this one cheap. I'm selling this one for a high price. That's why it's green. And but here this is red, which means that I'm actually overpaying a little bit for this strike. So by adding this traffic light, it helps me understand how far away the current price is from the typical price that I would normally see. And these numbers are essentially Z scores. So if the number is above 1 or in absolute value, either positive 1 or negative 1, like in this particular case, it's telling me that this is a very good condition because I am paying very little. The actual price for the 40 delta and for the 20 delta, it's much, much cheaper than I normally see every single day. And so this may be a good time to buy those two strikes. Now, the strike in the middle, the 30 delta strike, has a Z-score of 0.6, which is somewhere basically within one standard deviation. It's a little bit red. It's not the best. It's a little bit cheaper volatility than I would like to sell, but it's still within a one standard deviation. So this is not necessarily a bad thing, but it's, obviously if everything was green, it would be great because it means that I'm basically selling the highest implied volatility and buying the cheapest implied volatility than it would normally be. But you can always get everything you want. So, but at least this kind of analysis can help us understand what would be a good time to enter a trade, or maybe in a way, what would be actually a bad time to enter a trade. So maybe I stay away that day because everything is red, and I may actually enter a time where the skew is completely going against me. So again, that's why this understanding the skew and the rotation can help us in practical ways with real trades. Now, I know that I've talked a lot, so I don't know if there's any question or anything is not clear so far.
So you're predicting here, or you're saying it's good or bad for this strike in terms of what might happen. What would be the normal cause of those changes that you're anticipating? And would they be events in the market, or would they be merely the passage of time?
Well, the idea is like this. Let's say you go to the market and you buy, I don't know, you buy so you buy an apple every day and you pay $1 for an apple, right? And today is $1, tomorrow is $1.01, the next day is maybe 99 cents. So it's somewhere around $1 that you're paying every single day. If all of a sudden one day you find that the price of the apple is 50 cents, you may think, well, today is a good day to actually buy an apple. If it turns out that that day the price of an apple is actually $2, you will say, well, today is not a good day to buy an apple, right? So what this thing is doing is looking at historically instead of looking at what were the prices, what were the rotations? Okay, what was a typical rotation of the skew in the past? And then we're saying, well, how is the rotation today? is it better or is it worse? And is it significantly far away from the average? How many standard deviation away are we from the average? And if you are in the right, far away on the right direction, then obviously it's a good day to buy or sell a particular strike, because it means that the rotation, the skew is helping me with respect to, because it's a better day than what the typical day would be.
So we're hypothesizing that there's a distribution of changes
Correct.
from the current rotation. And we're looking for a pattern in that. Is there a chance that the history will not be repeat itself, but that we'll have a different distribution?
Yeah, we're looking at the distribution of these rotations and say, how is the rotation today? Is it actually an outlier? Because if it is in the average, then okay, it doesn't help me, it doesn't hurt me, it's just an average. But if I find a day where I'm far away from the mean, it's an outlier. Well, depending on if it's far away on the right side or on the left side, it might be actually in my advantage, or it may be against me. So depending on that, I may decide maybe today is a good day to trade it, or maybe today is a bad day to trade it, so I'm not going to do it.
Yeah, I think it's tremendously valuable, the indicators you have, to try and normalize some of these measures, because if they're just flying off the charts and the standard charts in all sorts of directions, unpredictably, constantly changing with time, you can't get any handle on it. So yeah, if you can normalize some of these values and allow people to see that on a graph, which you're doing, then I agree that's tremendously valuable. There are some questions. I'm not sure if they're still current.
Yeah, so I see a question from Sid that says, in put skew, you're saying that put spreads are cheap. How so? Maybe let me just go back quickly to these slides. Like I lost my slides. Okay, I'm showing slide. So let's just look at this example, right? Where we actually have put skew. Essentially, if I'm buying, let's say that I'm buying a put spread. So I'm going to buy this strike, and I'm going to sell this strike. Now, obviously, because of the put skew, the volatility that I'm selling, or the strike that I'm selling, is much higher than the volatility that I'm buying, right? If the volatility were actually flat, were just a straight line, there would be a certain price, right? I would pay a certain price for the one that I'm buying, and a different price for the one that I'm selling, obviously cheaper because it's farther away. However, because the implied volatility has this skew, the strike that I'm selling has a higher implied volatility, which means that the price of that option is going to be higher, right, compared to what it would be if both had the same volatility. And so that means that it's actually cheaper to buy, because I'm buying something, the one that I'm selling is basically paying me more. So it reduces the cost of buying this entire spread, which this means that when there's put skew, it's cheaper to buy a spread, but also means that if I actually were to sell the spread, I would not get paid that much, right? Because these put spread are cheap. And so I would not collect a lot of premium, because if I were to sell it, I would be selling the lower volatility and buying the higher volatility. So obviously I'm not going to get a lot of money for this, right? While in this case here on the right side, where, as you can see, the two volatilities are more or less the same, then you could say I'm selling something and I'm buying something else which is farther away. But the things that I'm buying farther away, it's obviously it's going to have a cost, but it's not going to cost me that much as it would be if the volatility were higher, right? So that's why the cost of this particular spread is actually higher. Or actually, if I'm selling the whole thing, it's a whole spread, I'm actually collecting more money. Essentially, when there is little to no skew, the differential in volatility is little, and so the actual prices, the difference in price is higher, and so the spread has a higher price. When the differential in volatility is higher, then the difference in price is lower. I know it's a kind of game of words, and so it turns out that the price of this spread becomes much cheaper if you're buying or collecting less money if you're selling it. Oh, Brandon said protector. Yes, that was a protector. Thank you so much. So also Brandon saying the skew indicator, could that be used to price out the structure like a butterfly to see if it's good pricing for entry? Yes, because you could say the theoretical rotation should be X, Y, and Z. Based on this rotation, I could say, well, this is the expected volatility that I should see for the strikes, which means that I can actually price the entire structure and say, this is the price that I should pay on an average, right? And if the price of the actual that I see in the market is higher, obviously it's not a good day to buy. If it's lower, maybe it's a good day to buy. So yes, it could be used for that.
Are you seeing that there are opportunities where there appears to be mispricing frequently, or does it get arbitraged out pretty fairly?
I would say that opportunities happen because it's impossible. I mean, there's so many different variations of strikes and days, right? And the market, each strike has different price patterns and like a different bids and asks. So these opportunities tend to happen quite frequently. Obviously, well, if everyone knew about it, yes, it would disappear, right? But because they tend to happen, I mean, fairly randomly. It's there's definitely an edge in having this type of knowledge, or at least knowing when the skew. This is not a good day because the skew is really not helping me. So the way I kind of look at this is because some of my trades are mostly done as a campaign. So I place a trade every week or every month or whatever it is, right? And so how do I look at this thing is mostly saying, well, today is the day where I'm supposed to place a trade. But if everything is red in my indicator, well, maybe I'll wait it out. Maybe I'll wait an hour, or maybe I'll wait until tomorrow and place my trade tomorrow, because tomorrow I may get a better condition, right? So I use it more as a way to stop me from doing trading rather than to use it for entering. Because if you're waiting for the perfect condition to enter, you may never enter because the outlier don't happen all the time.
I know that the sophisticated traders are already very carefully placing their wings and their spreads in the wing spreads relative to the skew. So the things you're talking about are already being done routinely by sophisticated traders. But I'm sure they could use every help they could get to visualize it, to normalize it. I think you got another question there.
Yeah, so Adam is asking, oh, sorry, that's okay. There was another question, I think, from Sid first, right? So, is there a way to take strike volatility shifts and rotation to speed out certain spread trades to be generated by the platform? I need to think about it. I'm not sure I understand the question. So you want to use both the shift and rotation to determine whether certain trades are more advantageous? I guess you can, same way as is done for butterflies, you can use it to determine whether those strikes that you're choosing have a good rotation or not. So I guess it could be done. But the challenge with this in general, with what I described earlier with the indicator, is that you need to collect the history of what was the rotation. Like it's like what were the prices of apples for the past 1 year, right? If it's always $1 and today is $3, well, I know that $3 is not a good price for buying an apple. But same ways, if I look at rotation is always a certain amount of degree, and all of a sudden it changes a lot, then I have a reference, right? I know that it's away from the average. So the problem with this is that you need to choose the strategy you want to trade. Then you need to collect data, the implied volatility of the strikes that you're selling or buying or whatever, right? And usually I do it by delta, not by actual strike. And then once I collect all this information, I can do the analysis and say, what would be, basically I build a model that tells me what the typical rotation should be. And once I know what the typical rotation should be, I can use that to inform my decision. So the process obviously is a little bit, it takes multiple steps. You basically need to have backtesting data to collect what the history of the volatility was for the strikes of your strategy.
Have you been running backtests to generate or accumulate such data?
Yes, for that Skew indicator, that's exactly what I did. I actually ran a 3-year. Basically, I ran a backtest using Quant Connect, using the, actually, for those of you who have seen I think it was the first presentation I did about Quant Connect, I used that software to basically kind of place puts at the delta that I wanted, and I looked at what was the implied volatility and collected all the information, downloaded it into a spreadsheet, and then I analyzed it, and that's what those charts were about. So I used the backtesting to basically download the data that I needed, and then I did my analysis in Excel.
Sounds great.
So Alan is asking, regarding calendars, is it better to use weighted Vega instead of forward volatility to test them? So in general, so definitely it's better to use a weighted Vega than the nominal Vega, than the normal Vega that you get from the platforms, because that gives you a much better sense for what the real Vega is, and you will find sometimes that, no, sometimes actually quite often, that a calendar that looks to be Vega positive, if you just look at the traditional Vega, when you look at the weighted Vega, actually sometimes is basically Vega neutral. It doesn't really get a lot, especially for longer dated calendars. So definitely using weighted Vega is, I think, is critical for calendars. Unfortunately, there's no platform that I'm aware of that shows you the weighted Vega. So you have to basically kind of roll up your sleeve and use kind of these simple calculations. Now, the other method, what you mentioned here, the forward volatility, I don't know if you were mentioning you're referring to the other method that Taleb is describing in his book. That would definitely be a more accurate calculation, because because the way the Vega works is basically applies a time weighting based on the fact that the time goes with the square root, the volatility changes with the square root of time, and that's obviously a theoretical model. The other approach described by Taleb is actually using the real volatility term structure, basically looking at what the actual volatility is for each points of the term structure, and using that to calculate what the weighting should be. So it's a more complicated approach. It's definitely more accurate, but it's also more requires that you actually need to have all this data. And at the end of the day, I don't know how much more accurate it would be. I think, I mean, it may be more, but I feel like that using the weighted Vega with a simple formula, I think it's kind of good enough to at least to give you a sense for what the real Vega is. Because using the nominal Vega, especially trading calendar, it's a bad idea. I mean, you really cannot rely on that Vega. It means absolutely nothing when you're trading calendars.
Does anyone else have a question? Does anyone who here trades? I mean, I'm sure we've got butterfly traders here. Do some of them and other legged creatures traders? Do some of you already do this kind of, at least, or what you can do on Skew? Do you carefully consider Skew in placing the legs of your trades? Does anyone do that? Or who has any other question? Rocco, you mentioned Taleb's book. Have you partly based your work on Taleb's book?
No, in this is just based. I mean, I put a link actually to his book. You can find it online. Right. It was somewhere.
I saw it on your slide. Yeah.
There's a link there. You can find it. So that that link is primarily there's a section in chapter 9 that describes this concept of weighted Vega for those of you who actually want to look at the forward volatility model and other things. Now, that book is not necessarily for the faint of heart, because there's a lot of formulas and things like that. So, but the concept of the weighted Vega is fairly easy to understand. So, even in his book, it explains it very well. But for this piece of the rotation, no, I didn't use that book. This is something that I kind of came up with it. Now, maybe there are other ways to do it. Maybe somebody else has other people have different ways of approaching this problem. So I would definitely love to hear some feedback. But yeah, this is as far as I got so far.
Hasn't there been a lot of controversy? I don't remember what the controversy was, but hasn't there been some controversy about weighted Vega? I'm not sure what it was, but I know everybody was talking about it, and I think some people were disagreeing with other people. I don't remember. Let's see. Brandon says he's been doing some of this. What has been your approach, Brandon, to handling skew? How do you handle it? You want to maybe turn on your mic and say something? Share us a little bit to get a little dialogue going here. He says to a degree he's used it, but not to Rocco's level. Okay, Sid talks about double calendars. And that would be getting pretty complicated, would it not?
Well, double calendars actually, that's where actually you need both the weighted Vega, because they are calendars, so you need to use them for calculating the real Vega, and you need to use the rotational Vega, because the skew across the put side and the call side of your double calendar obviously changes. So understanding what the effect would be of a rotation of the skew would definitely be relevant. So yes, double calendar is definitely something that understanding how the skew works and how your rotational Vega works, you could take advantage of the rotation.
Sure. Brand, were you going to say something there? Oh, he says, so the skew indicator, he has a comment there. So a skew indicator, could that be used to price out a structure like a butterfly to see that it's good pricing
Yes,
for entry?
yes. Yeah, I already answered.
Oh, okay, you answered that.
Hey there.
Hi, Brandon.
Yeah, I mean, I scale into butterflies weekly and kind of build up campaigns and into a larger structure, and I try to find the best day to scale in that looks the most advantageous. But I mean, to Rocco's degree, no. So, I mean, I'm looking at like the S-Dex and the T-Dex and different volatility measures and just modeling them out in Option Net Explorer to see how the risk graphs look and everything like that. And, try to find a good day to put it on. But the Excel that Rocco's...
Do you try and place like this individual legs so that they're in the right place on the skew curve?
Well, see, that's where I don't get to drill down as far as what Rocco's, like the Excel he was showing, I think is interesting, because I kind of model out the whole structure and then I'm looking at the whole thing to see, how the risk graph looks compared to all the back tests I've done and whatnot. So, if I can see that, it looks bad today, it looks good this day based on just past trading and of time looking at the charts and whatnot, but it looks like Rocco can say why it looks bad certain days. So I don't get down to that level.
And to be honest with you, I mean, even with the Excel and everything else, I mean, at the end of the day, getting used to, if you do a trade every single time, right, you already know how much you should pay for that trade. I mean, if you've done enough, you know what the typical price is. And of course, it can oscillate and things, but and sometimes, as you said, Brandon, you just put it on Option Net Explorer. You see right away this thing doesn't look good, right? I mean, you look at the T0, it's like it's ugly or whatever, right? Or has too much gamma. So you can spot by trading something often, you get very used to understanding whether, I mean, somehow can you build indirectly that knowledge. This kind of helps me a little bit more, because obviously it gives me some quantitative reason as to the things that I was thinking would be good trades. sometimes were not necessarily there because, and then this helped me understand what the reality was, right? Because sometimes when all of the softwares that we use, whether it's one Option Explorer or others, you know, they all use these, they make approximation, they don't use weighted Vega and all these kind of things. And so you have to, obviously, you know, it's not everybody's fault. It's just the way software works. It's just, these are just models and not every model is perfect. So that's why I started studying a little bit more to try to understand what was happening and why certain days that I thought it would be a good day actually turned out to be bad or whatever, right? So that's the kind of the reason why I did this piece of work.
Well, I've seen some people put out elaborate spreadsheets, historical spreadsheets of pricing a butterfly and at certain legs historically, and they try and draw patterns from that. And obviously, if they could try and get some normalized values from that, it would greatly simplify it, as opposed to simply saying, well, we'll look at such and such a delta. When you can normalize Vega across strikes, then that would allow them to compare one strike to another, as opposed to always having to look at the same strike and the same time period, the same expiry.
Yeah, and the reason why I looked actually at both the delta, I measured the distance between strikes in delta, not in actual numbers, because obviously as implied volatility changes, if you just look at the 30 delta, 30 widespread or 50 widespread, it makes no sense, because when the volatility is different, you really want to look at the distance measured in delta. And I looked at the rotation rather than the prices, because prices again are much more sensitive to the actual absolute volatility that we are in, versus the rotation is more kind of a structural form of the curve. And so you can understand the relative aspect of how the rotation is changing.
Yeah, you can factor out the implied volatility, so you don't have to have a completely different set of values for every type of volatility. So that's great. I mean, I think I'm working on a tool, and I think probably you are too, some graphing tools of your own that eventually we can bring out these values.
Yeah, so this is the Excel one I was telling you, like, obviously I cannot share that one, but there's there's a Google collab that I'm building. It's almost there, and that's something that I was planning on sharing. Eventually I'll do it as soon as when it's finished.
Sure.
And it would be something like the Excel that I show you, but kind of mostly related to graphing a position, having ability to increase volatility, change volatility, change. It's like a mini one or a mini Thinkorswim, but with the ability to actually see the weighted Vega and the rotational Vega. So that would be really the net new things. Actually, I would love if Thinkorswim or Option Explorer will actually add these two things, so I wouldn't have to build all of these things by myself. But I mean, it is what it is.
Yeah, just if I could chime in on that one, that would be very helpful in the sense of, like, when I model out a structure, I like to stress test it, but most of these tools aren't great. Like you were talking about weighted Vega, you know, an option one, if we increase the vol up and down, that's not very accurate of what it's doing. But if you had some sliders that could adjust weighted Vega or skew based on the strikes that you have on a particular structure to see, you know, stress test where that's going to affect your margin and whatnot, that could be very helpful.
Yeah, we should aim to do those things, you know, and I know that Rocco is already working in this area, and hopefully other people are too. There seems to be a lack of innovation in graphics packages for options analysis. I mean, we had option view and it's died off, and so it's not helpful.
Yeah, but actually the thing is, because of option view closing shop, now optional explorer is kind of the only one left.
Yeah.
So they have a kind of a dominant position, and but I'm shocked by the fact that they're not innovating that much. And I think they, you know, I mean, I think it's because they are the only one. You basically are stuck with them. But it would be nice to see some of these new stuff. I mean, weighted Vega has been sitting around for years. It's not like it's not coming up today, and yet no software is actually showing it. Actually, Interactive Broker has a weighted Vega which instead of using 30 days, uses 1 day. So that's but Interactive Broker has a
Oh, really?
not a super nice UI, so to speak, or charting capability. So yeah, it gives you the number, but it doesn't really help you that much.
What's your overall impression? While we're talking, it's a background topic, not the main one, but what's your overall interpretation as to the exploitability of let's say income trading or other forms of option trading? Does the market still lend itself to highly profitable butterfly and other trading, or is it becoming less and more efficient?
I would say, I mean, I can only talk for the personal experience for the things that I'm trading. But in my case, butterflies, broken with butterflies, calendars, and some variation of those things, some more kind of exotic structures. But these are my bread and butter. I don't do iron condors or selling spreads. I mean, you'll almost never see me do things like that. And I trade on the T0 line. I trade on the theta, and combining butterflies with calendars, you can kind of equalize different aspects, because like the Vega itself, like you try to add some positive Vega on one side and some negative Vega on the other side to kind of balance things out, or I mean, again, I'm always trading the T0 line, but what I'm saying is basically butterflies are I think some of the most powerful structures that there are, and you can get pretty much the delta neutral with butterflies compared to if you sell a spread or obviously or a naked, you have a lot of gamma, you have a very your bullish delta or whatever, or I mean, your delta is way too high. So it doesn't work well for income trading. It works for directional trading, which is great if you are a directional trader, but I'm not. I'm terrible at picking a decision direction. I mean, I have to say I use a lot the gamma exposure and the Van exposures charts to help inform where the positioning of the market maker would be, and I find that to be very predictive. So if you guys ever seen the jacks or VAX, in my mind, I think they're very, very helpful in understanding where the market dealer positioning would be, and that helps you understand where the stock is going to move. Having said that, I don't use that information for pure directional trading, but mostly for placing my range of position if I'm doing a butterfly or whatever I'm doing, so that I'm covering the area where I think there's a high probability that the underlying will end up staying.
You're referring to gamma exposure there?
Yes.
Mm-hmm.
Yeah, understanding gamma exposure, and actually that chart that I was showing earlier from the Discord channel, it's where I was showing the skew is actually also shows the gamma exposure by strike. So you get and it's a pretty good it's a pretty good chart. I mean, I have to say it picks it up quite well. I mean, so it's quite predictive.
If you want to look for gamma exposure, which instrument is it best to look for it in? Like the futures?
No, I mean, I always because I'm 99% of my trades are on SPX.
Yeah.
So I always look at the SPX gamma exposure. So the only problem is that it's based on the open interest, and the open interest only comes once a day at 8:30 in the morning. Now the JAX changes over time during the day, because options are expiring, and so their gamma is also changing. But the actual open interest doesn't change, because they only publish it once in the morning. There were I think the CBOE was discussing the potential of publishing the open interest actually multiple times during the day, not just once a day, and I think that would help a lot. So for now, I see that somebody, instead of using the open interest, uses the volume as a proxy to calculate the JAX during the day, but I find it to be less accurate. I prefer to actually use the open interest, and at least from my personal experience, that counted as a sample of one, so it's not necessarily significant. But in my case, I feel it's a little bit more accurate.
Well, that's great. I mean, I'm looking at the gamma exposure stuff too, and I know you've spoken before about it, so it's great that we have the indicators we can get. Does anyone else have any questions? Did you want to cover anything else, Rocco, or mention anything else?
No, I think I talked enough for today. So
Okay.
apologies if some of these things were a little bit too much math or too many things. So feel free to reach out to my email if you have any questions or follow-up.
Fantastic. Well, thank you very much. Then we won't prolong it any further. We'll have the recordings. Yes, somebody asked. We definitely will have the recordings on very soon. Thanks, Conrad. And we'll leave it at that. Thanks to Rocco. Thanks to everybody. Thank you. Good night.
Thanks, everyone.
Thank you. Good night.